Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Welcome back to the channel, traders. Today, we're diving deep into a fascinating microcap stock that recently popped up on our hard-to-borrow screener, FCUV. We're going to break down why FCUV is an eye-popping cost to borrow, what that means for potential short squeeze mechanics, and what you need to know about its recent reverse stock split. This isn't just theory, we're using real, current data for FCUV to show you exactly what to look for. Let's talk about FCUV. As a microcap stock, it often flies under the radar, but its current lending dynamics are anything but quiet. Looking at the recent price action, it's been incredibly quiet. FCUV has seen a plus 0.0% change today, plus 0.0% over the last 5 days, and plus 0.0% over the last 30 days. The chart static, showing flatline. The slack of movement is reflected in the volume. Today's volume sits at stark 0 shares, with a 30-day average volume also at 0 shares. This means its relative volume is 0x average, essentially no trading activity whatsoever right now. Highlight 0 volume. However, what makes FCUV so intriguing is its current annualized cost to borrow fee, which is an incredible 940.1%. Yes, you heard that right, almost 1,000%. With an estimated float of just 0.6 million shares, this tight supply, coupled with such a high fee, is why it's on our radar. Our internal composite squeeze score for FCUV currently stands at 40.6 out of 100. What is cost to borrow and why each matters? For those new to short squeezes, let's quickly explain cost to borrow, or CTB. Joe animation loaning shares. When a short seller wants to bet against a stock, they first have to borrow shares from a broker. The cost to borrow is the annualized interest rate they pay to hold those borrowed shares. Think of it like a very expensive loan. When the CTB is low, it's cheap to short. But when it skyrockets, like FCUV's 940.1%, it signals one of two things. Either there's incredibly high demand from short sellers who are willing to pay almost anything to bet against the stock, or, and often more relevant for squeeze plays, the supply of available shares to borrow is incredibly limited. These can exceed 100% annually because the supply is so constrained, and demand to borrow remains high. Why the stock is hard to borrow right now. So, why is FCUV specifically hard to borrow right now? The staggering 940.1% cost to borrow tells us there's significant pressure in the lending market for FCUV shares. While the exact number of shares currently available to borrow is unknown, this sky-high fee suggests they are either extremely scarce or non-existent. Combine this with FCUV's estimated float of only 0.6 million shares, that's a very small pool of publicly traded shares. Highlight float size. If even a modest number of these shares are already shorted, or if institutional holders are unwilling to lend them out, it creates immense pressure on the cost for anyone new trying to establish a short position, or for existing short sellers needing to roll over their loans. Squeeze mechanics explained. This brings us to the core concept, a short squeeze. Chart animation. Short squeeze process. A short squeeze occurs when the price of a heavily shorted stock rapidly rises, forcing short sellers to buy back shares to limit their losses. This buying demand further drives up the price, creating a cascade effect. For a stock like FCUV with its 940.1% CTB, short sellers are bleeding money every single day they hold their position. This extreme cost can act as a powerful catalyst, potentially forcing them to cover their positions, especially if the stock price starts to move up, even slightly. However, and this is crucial, a high cost to borrow does not guarantee a squeeze. It can also mean that the short sellers have incredibly strong conviction in their bearish thesis and are willing to pay almost anything to stay short. Dilution risk check. Now let's talk about dilution. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This typically dilutes the value of existing shares and can completely negate a short squeeze thesis, even with high cost to borrow. Why? Because it increases the supply of shares available, giving short sellers more opportunity to cover their positions without driving up the price, or even enabling new short positions. For FCUV, we have good news on this front. Our check found no recent dilutive SEC filings, such as SMINUS-1, SMINUS-3, or 424B, in the last 90 days. This means there haven't been any recent public offerings that would add new shares to the market. Recent reverse split watch. Another important factor for FCUV is its recent corporate action. FCUV executed a 1/4-4 reverse stock split on 2026-6-23, which was 48 days ago. Share animation reverse split effect. A reverse split reduces the total number of outstanding shares and, in theory, increases the share price proportionally. For example, if you owned 4 shares after a 1-4-4 split, you'd own 1 share worth the combined value of your original 4. This effectively reduces the float, the number of shares available for trading, which can intensify short interest dynamics. Historically, many microcap stocks tend to see renewed volatility or price pop within about a month after a reverse split, as the reset share price and reduced flow can attract new attention. While FCUV split was 48 days ago, slightly outside that typical month window, it's still a significant event to keep in mind, especially given its current liquidity. This observed pattern is not a guarantee, but a tendency seen in some microcap names. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Given FCUV's unique situation, 940.1% cost to borrower, a tiny 0.6 million share float, currently 0 trading volume, and a relatively recent reverse split, what should you watch for? Any sudden uptick in volume, even a small amount, could be significant. With 0 shares currently trading, any buying interest would immediately stand out. Look for any news or catalyst that could draw attention to the stock. While its composite squeeze score of 40.6 isn't extremely high, the extreme CTB is a powerful indicator of underlying pressure. Keep an eye on any reported changes in borrow availability or short interest data if it becomes available. Remember, the extreme liquidity means any price movement would be very noticeable. FCUV presents a fascinating case study in hard-to-borrow stocks. The staggering 940.1% cost to borrow, combined with its micro-cap status and tiny float, makes it an intriguing name to monitor for potential short squeeze conditions. However, the current 0 volume and the fact that its reverse split pop window may have passed are also important considerations. Always remember that a high cost to borrow is a signal, not a guarantee. Do your due diligence. Stay informed. And trade wisely. If you found this breakdown helpful, please hit that like button, subscribe for more deep dives into hard-to-borrow stocks, and let us know your questions in the comments below.